Hello, everyone, and welcome to today's XTERA Education call. It's great to have our entire community together again. A community that is growing, evolving, and proving every day what's possible when vision meets execution. First of all, congratulations to all of you. October was truly remarkable with a record number of new customers. The energy, the momentum, the excitement was visible everywhere. During our Colombia tour, we met so many new faces, new partners, new leaders, people who instantly understood the power of what XTERA is building. Those conversations reminded us why we are here: to create value, to elevate each other, and to build something that lasts. Long term and stability are our main goals. Now, I want to reflect on a specific market situation that happened just a few weeks ago. Take a look at that slide. It's more than a picture showing just numbers, it's a statement, a message about who we are and how we operate. On October 10th, the global markets experienced one of the darkest days of the year. Crypto dropped sharply. Major exchanges, including the New York Stock Exchange, were shaken. It was chaos. Fear was everywhere. But look at how XTERA and our traders responded. On a day when the world was completely red, we executed around 11 trades. And 10 of those trades were winners. Only one losing trade. Over 90% success on a global crash day. That is not luck. That is not coincidence. That is experience combined with discipline, expertise at the highest level. It proves that our system works, not just on the good days, but especially on the difficult days. This is the kind of performance that builds trust, the kind that makes people say, I'm in the right place. And that is what XTERA stands for: confidence, preparation, intelligent execution. Your portfolio is not driven by emotion, but by experts who do this better, faster, and more consistently than any individual could. This is your partner. This is your ally. This is your advantage. Today, we continue that journey. We are welcoming back someone who has already delivered incredible value: our trainer and educator, Dominic. Dominic will guide you through one of the most important topics in trading: how your emotions influence your decisions and how mastering them contributes to long term success. His training shows exactly why XTERA's structured, emotion free professional strategy is so powerful. It removes fear, it removes guesswork, and it replaces them with clarity and consistency. That is how wealth is built. That is how long term success is achieved. So, thank you for being here. Thank you for being part of this mission, this movement, this community. October was amazing, but it was only the beginning. Let's keep building. Let's keep growing. And let's make November and December a month to remember. And now let's welcome Dominic. The stage is yours.
Thank you, Daniel. Hello, everyone. I'm very happy to see you again. And I really want to thank the XTERA team for allowing me to come back today for this new session. It's always a pleasure to be with you because I can see that you form a curious, engaged community, and above all, one that's eager to make progress. And believe me, that's already a huge advantage in a world where most people would rather complain about not understanding than make the effort to learn about finance. So really, congratulations for being here. You're already part of the minority that's moving forward. And today we're going to talk specifically about what helps you move forward. Because this session is a bit special. We're building a bridge between the technical side, which we often see in trading, and something we talk about much less, the human aspect, the mindset, the reflexes, the way we make decisions under pressure. I'm going to tell you something that honestly took me way too many years to understand. The market doesn't reward the smartest people, it rewards the most disciplined. And I discovered all of this through my interactions with professional traders. Throughout my journey, I had the chance to talk with people who have been trading for 15, 20, 30 years. Men and women who have lived through crashes, bubbles, periods of euphoria and panic. And one day, one of them, a brilliant guy based in London, said to me over coffee, "Dominique, the market doesn't punish bad strategies, it punishes bad emotions." I stopped dead in my tracks. I said to him, "What do you mean bad emotions?" And he replied very calmly, "Yes, most people more or less know what to do, but their emotions prevent them from doing it properly." And at that moment, I realized that everything we imagine to be the difficulty of trading, the charts, the analysis, the tools, is actually almost secondary. It's important, of course, but it's not the heart of the matter. The heart of the matter is psychology, discipline, the way we react when something surprises us, when a position goes bad, or even when everything is going too well. And I'm sharing this idea with you today because it completely changes your relationship with trading. Because the more you understand market psychology, the more you realize the value of working with professionals who have locked their emotions away in a tightly sealed box. In other words, you need to delegate operations intelligently. In the previous sessions, we laid the foundations together, the structure of a comprehensive financial strategy, the mindset of being the CEO of your financial life, the role of trading in accelerating performance, and ultimately how to manage your capital to finally put your money to work. Today we're going to take it up a notch, go behind the scenes, and talk about what no one really teaches. How does our brain function when faced with the market? Why do 90% of individual investors make the wrong decisions at the wrong time? And how, without becoming a trader, can you adopt the mindset of professionals? You'll see, it's fascinating. We're going to talk about you, about us, about our reflexes, our fears, and our natural overconfidence. And then you'll understand why trading is not just a financial tool. It's also a mirror to help us get to know ourselves better. All right, let's get started. Key number 1, the 7 psychological traps that ruin financial decisions. We're going to start this session with a truth that I want each of you to keep in mind. Most financial mistakes are not technical errors, they're psychological errors. Our brain is designed to survive in a hostile environment, not to perform in financial markets. When faced with volatility, a red candlestick, or an economic announcement, our brain reacts as if a tiger were chasing us. It releases stress and adrenaline. It wants to make us flee or fight. Except that the markets are neither a tiger nor a real danger. And that's where the trouble begins. With this first key, I want to introduce you to 7 psychological biases that trap all of us, no matter our level. I promise you'll recognize yourself in at least 2 or 3 of them. And that's normal. No one escapes them. The difference is that professionals spot them, and most importantly, they deactivate them. First, cognitive bias. FOMO, the fear of missing out. If you were to remember only one bias, it might be this one. FOMO is that very unpleasant feeling that everyone else is making money except me. And let me reassure you, it doesn't mean you're naive or impulsive. It's simply a primitive reflex, following the group to increase our chances of survival. The problem is that in the markets, following the crowd often means arriving at the wrong time. Look around you. Bitcoin in 2021, trading volumes explode and we're right at the top. Tesla in 2020, everyone is talking about it right before a correction. Nvidia in 2023, media frenzy just before the consolidations. I've even seen people buy an asset simply because someone they trusted told them, "I just invested in it." That's not a strategy, it's an emotional reflex. The professional, on the other hand, does exactly the opposite. When they see a price rising too quickly, they don't think, "I'm going to miss out on something." They think, "But who is buying at this price? And why shouldn't I be the one making that mistake?" Bias number 2, loss aversion, what we call the silent saboteur. Daniel Kahneman, Nobel Prize winner, demonstrated this. Losing 100 euros hurts twice as much as the pleasure of winning 100 euros. That's huge. And that's why most individual investors take their profits too early and let their losses run for too long. It's almost mathematical. I've seen investors say, okay, I'll cash in 40 euros of profit. That's always nice. And then they'll hold on to a loss of up to 300 euros, telling themselves it'll come back up. This reflex destroys fortunes. Professionals, on the other hand, have a sacred phrase. Cut your losses quickly, let your profits run. And it's not just a nice saying, it's a repetitive behavior, an automatic reflex, almost a military discipline to adopt. Bias number 3, confirmation bias. This one is sneaky and absolutely universal. You have a hunch, for example, that oil is going to go up. So what do? You look for reasons to confirm that hunch. You go on Google and type, why will oil go up in 2025? And you click on the articles that validate your idea. It's human, but it's disastrous. An investor who doubles down on their belief becomes blind to opposing signals, and the markets couldn't care less about our beliefs. Professionals, on the contrary, first look for arguments that will contradict their ideas. They test their convictions. That's why a trader once told me, when I have an idea that's too appealing, I try to break it before I fall in love with it. Bias number 4 is herd bias, the temptation to be like everyone else. Our brain loves being part of the group. Human beings are not made to make decisions alone. If 20 people start running and shouting, help, you'll run with them and you'll be right to do so. In nature, that can save your life. But in finance, it's a disastrous reflex. In a bull market, the herd often buys when it's already too late. In a bear market, the herd will sell at the worst possible moment. There's a harsh saying on Wall Street that goes, when your taxi driver starts giving you tips on financial assets, it's time to sell. In other words, when everyone agrees, it's already too late. The 5th bias is what we call overconfidence, the illusion trap. This overconfidence often comes after a few quick successes, and it affects everyone. The first time you make 3 gains in a row, you feel invincible. You feel like you figured out something that others haven't seen. And that's when your bets get bigger, your caution drops, and your ego takes the wheel. The problem is, it's the market that will bring you back to reality. In France, the Financial Markets Authority publishes a harsh statistic. 75 to 85% of retail traders lose money after 1 year. Not because they can't read a chart, but because they overestimate their abilities. The professional trader, on the other hand, will always remain humble, even after 20 years of experience, even if he has made millions. He knows that the market can prove him wrong, even when he believes he did everything right. The 6th bias is what we call the Dunning-Kruger syndrome. I call it the 3 YouTube video syndrome. You watch a few videos, you feel like you understand everything, and you think you're ready. The problem isn't naivety, it's what you don't see yet, what you don't know. The beginner sees only the small hill in front of him, while the professional sees the entire mountain range. And that's why professionals are cautious. It's a profession. This bias explains why beginners often take risks they don't understand and why they panic at the first downturn. The 7th bias is the present bias, the enemy of patience. Our brain places a huge value on anything related to immediate rewards. It's natural, it's biological, it's instinctive. It's this bias that makes us want a gain right now. We hate waiting. We have trouble sticking to a long-term plan. We look for quick gratification instead of lasting performance. The market, on the other hand, rewards the opposite. It rewards patience, long-term horizons, and consistent strategies. That's why the most successful investors aren't the fastest, but the most consistent. And let me share a personal story with you. It's about the day I realized that I was my own problem. I remember a time when I wanted to force the market to validate my intuitions. I had a conviction. I thought it was brilliant, logical, perfectly analyzed. And when the market told me the opposite, I got angry. I complained. I stayed in my position. And I would tell myself, this can't be. It has to end up going my way. And of course, it often ended very badly. And then one day, an experienced trader said to me, "But Dominique, the market doesn't care at all about your logic." It was a slap in the face, but a good one, the kind that puts things back into perspective. It's that wake-up call that I'm trying to give you today. The market isn't against us. It's never on our side. It doesn't care. But our biases, on the other hand, work against us at every moment if we don't take back control over them. So, to conclude this first key, the key, these 7 universal biases affect beginners, intermediates, advanced traders, and even professionals. Except that professionals, they've learned to recognize them, anticipate them, neutralize them, and above all, not let them make decisions for them. This first key is fundamental because it reveals a simple truth. Performance doesn't come from technique, it comes from mental clarity. And that's where we start to understand the value of smart delegation. Entrust tasks that require coldness, rigor, and emotional neutrality to someone whose job it is and whose emotions aren't involved. So now that we've seen what can mentally trap us, let's look at how professional investors structure their discipline and why that's what protects them during storms. Ready for key number 2? Let's keep going. The 3 pillars of financial discipline are the backbone of professionals. In the first key, we saw how our brain can literally trap us. Now, what I'd like to show you is what professionals have put in place to neutralize these traps. Because let me reassure you, the pros aren't emotionless machines. They experience exactly the same biases as we do. The difference is they don't let their emotions drive their decisions. So how do they do it? Thanks to discipline. It's their secret weapon. This discipline is based on 3 pillars, 3 elements that are simple to understand but hard to put into practice. And as is often the case, what's simple isn't necessarily easy. Today, we're going to see how these 3 pillars can transform the way you invest, even if you delegate your trading. Pillar number 1, a clear, written, and fully owned strategy. I'm starting with this one because it's the main difference between an amateur and a serious investor. Most individual investors operate with a very rough system. This looks interesting. A friend told me about it. I saw a video, it's going up a lot, I don't want to miss out. But if you ask them, why did you buy this asset? What is your goal? What is your exit plan? Very often, there isn't a clear answer. In reality, most people start investing without an instruction manual. Imagine for a second, you get on a plane and you hear the pilot say, "We're going to try to get to our destination. We'll see depending on the weather, on my mood, if I feel inspired." Would you stay on board? No. Well, neither would I. And that's exactly what 90% of individual investors do with their investments. They're flying blind. They react more than they make decisions. Professionals, on the other hand, have a written strategy, written down on paper, not just in their heads. Why written? Because when emotions run high, and rest assured, they always will, this written document, this framework becomes your safety net, a contract with yourself. Warren Buffett himself says, if you don't know why you bought, then you won't know why you should sell. Having a written strategy means deciding in advance what you want to do. Decide with a cool head, execute when things heat up. And between us, even if you delegate, it's fundamental because delegation works best when you know exactly what you expect from it. Pillar number 2, a reproducible method, a ritual that prevents bad decisions. Now we're getting into the tough part. The method is what turns a strategy into concrete results. A successful investor doesn't have a perfect approach. He has an approach that can be duplicated. He knows what to do, when to do it, and above all, he knows what absolutely must not be done. And believe me, that's often more important. One day, a professional trader told me a phrase that was almost funny, but so true. He said to me, "Dominique, I'm not paid to be brilliant. I'm paid to be consistent." That's powerful because the market doesn't reward creativity. It rewards consistency. When I observe retail traders, the first thing that stands out is inconsistency. One day they're investing for the long term. The next day they want to do scalping. Then they watch a crypto video and the next day they sell everything. Imagine a surgeon who changed instruments every 30 seconds. That would be dangerous. A professional trader, on the other hand, has a ritual, a real mental protocol. He analyzes first, defines the risks, knows exactly where to exit if things go wrong, and knows where to exit if things go well. But above all, he follows a ritual, even if he doesn't feel like it, because the method protects against impulsiveness. A trader once said, "When I have a bad feeling, 95% of the time, it's just my ego talking." That sentence stuck with me. The method is what prevents you from making a decision because you're tired, excited, frustrated, or euphoric. And in the markets, an emotional decision can be very costly. Which brings us to pillar number 3, a control framework, the favorite part for professionals and perhaps the most hated part for individual investors. The last major difference between amateurs and professionals is precisely control. The individual investor looks at their portfolio hoping, "I hope it goes up, I hope it recovers, I hope it works out." The professional investor, on the other hand, looks at their portfolio by measuring performance, risk, and consistency, volatility, stability, and duration of exposure. And they measure these indicators regularly. I'm going to tell you something a bit harsh but fundamental. As long as you don't measure your strategy, you don't have a strategy. You just have a hunch. Control gives you power. It gives you clarity. And it's that clarity that will lead to performance. The professional trader uses KPIs, simple indicators. Ratio, profit and loss, maximum drawdown, percentage of winning trades, annual volatility, risk per position. And what's most interesting is that they never try to cheat with the numbers. Because the goal is not to be right. The goal is to understand how to improve your method. That's why professional managers often keep logs and statistics. They don't just look at the final results, they observe the mechanics behind those results. It's those mechanics that really make the difference over 2 years, 5 years, 10 years, and help you maintain consistency. And actually, I have an anecdote, a lesson in discipline that a fund manager once gave me. I remember I spent time with him a few years ago, and he was someone with incredible discipline. And one day I asked him, "How do you manage to stay so consistent in your results?" And he answered me, "Actually, I don't control the markets. So the only thing I can control is my decisions." I said to him, "Yes, but still, you must have emotions and doubts too." And then he said to me, "Well, yes, I have doubts every single day. The difference is that my decisions don't depend on my doubts." And that sentence is the whole key. Discipline doesn't prevent emotions. It prevents emotions from expressing themselves in your decisions. So, why is this so important for you, even if you delegate your trading? This is where this key takes on a very interesting dimension. Even if you don't trade yourself, even if you delegate part of your capital to a professional team like XTERA's, discipline is still essential. For 3 reasons. Without a strategy, you're delegating blindly. And if you delegate blindly, the results themselves will be unclear. Without a method, you'll be tempted to change everything at the wrong time. One tough month and you change your approach. One euphoric month and you increase your stake. These are the worst instincts. Without control, you don't know what works. And an investor who doesn't know what works is doomed to repeat the same mistakes. So, to conclude this key point number 2, remember 3 things. A professional investor never improvises, they plan. A professional investor doesn't try to be brilliant, they strive to be consistent. A professional investor doesn't try to predict the market, they aim to master their own reaction to the market. And that's what makes all the difference. When you adopt these 3 pillars, a clear strategy, a repeatable method, and a control framework, you move to a whole new level. You shift from the "I'm trying" mode to the "I'm in control" mode. And you understand why delegated management can become a powerful lever. Because it allows you to maintain strategic discipline while letting professionals handle the operational discipline. Now that we've seen how to structure discipline, we're going to go even further by tackling market cycles. This is a key topic because understanding cycles means understanding where you are and how to move forward confidently in any economic climate. Let's move on to key number 3. Understanding cycles, this compass for the intelligent investor. So now that we've seen how the brain can trick us and how professionals structure their discipline, I'd like to share with you this 3rd, absolutely fundamental key, the one that deals with cycles. Because in finance, in the economy, in the markets, everything is cyclical. Nothing is linear. Nothing progresses. in a straight line. And above all, nothing is permanent. The most fascinating thing about all this is that cycles don't just apply to charts, it concerns human beings. You'll see, understanding cycles means understanding how to move forward without panicking, how to stay clear-headed, and how to take advantage of the markets, even when they seem unpredictable. This key is truly your compass as a modern investor. First cycle, the economic cycle, the natural rhythm of a country, a market, an era. Let's start with the broadest one, that's it, the economy. If you look at the world economy over the past 50 years, you'll notice a simple phenomenon. It rises, it slows down, it corrects, it starts up again. It's almost like breathing, like a beating heart. We always go through 4 major phases. Expansion, everything is going well. Strong growth, companies are hiring, wages are rising, people are spending. It's a period when everything seems easy. People talk about innovation, projects, long-term vision. It feels like the future is guaranteed. Except that after this comes phase 2, the slowdown. The signals become more cautious, interest rates rise, companies slow down their hiring. Weakens and households spend a little less. People start talking about uncertainty. It's a bit like the machine starts breathing more slowly. Then comes the third phase, the recession. The word is scary, but in reality, it's a natural, frequent phenomenon, like a season, an economic winter. Companies reorganize, they spend a little less, and investors become a bit more cautious. And yet, it's during these periods that the best opportunities are born. The best stocks, the best companies, the best innovations, Google, Meta, Uber, Airbnb, all of them emerged during or just after a crisis. And then phase 4, the recovery. After winter comes spring. Companies get going again, confidence returns, markets take off, even before the economy is officially back on track sometimes. And little by little, we return to the expansion phase. And there you have it, the cycle starts again, and in reality, it never truly stops. This economic climate, we know it's always changing, but it's never unpredictable. Which brings us to the second cycle, the market cycle. The emotional map that we too often forget to look at. Now that we've understood the economic cycle, let's tackle the most important cycle for an investor, the financial market cycle. The markets themselves don't follow reality. They follow emotions in advance. They anticipate, they exaggerate, they panic, and then they exaggerate in the other direction. There is a kind of universal pattern that represents this emotional cycle. And I guarantee you've experienced it even without knowing it. You'll recognize every stage. First, optimism. Hey, this looks interesting. You start hearing about a market, an asset. You think there's an opportunity here. Second, excitement. It's going up. I knew it was a good idea. People get in because they see the first gains. Phase 3, euphoria. It's incredible. It's easy. It's the future. Everyone is talking about it, even those who were never interested in finance. And that's often when the general public starts buying. It's also when professionals surprisingly start selling. And then comes doubt. Damn, why is it going down? It's just a correction. We try to reassure ourselves. Denial. No, but wait, there's no way it could drop any lower. We look for articles that confirm this optimism. And then fear. Okay, now I admit it's getting serious. You check your portfolio every 3 minutes, which is soon followed by panic. I sell no matter the price. And that's the worst decision. Even if it seems logical in a panic, that's the one that will really make you lose money. Phase 8, capitulation. It's over, I'll never touch an investment again in my life. And that's often the bottom. Disinterest. I'm done. The markets recover, but I don't want to hear about it anymore. And then little by little, things pick up again. A kind of accumulation. Serious investors start coming back. They buy back slowly, calmly, and that's the recovery. The cycle starts over, and we often get caught in the trap again. This psychological cycle is also the cycle of the beginner investor. I remember a young investor I mentored. He had read everything, watched everything, and thought he was ready. First trade, he wins, he's thrilled. Second trade, he wins again, he feels invincible. Third trade, he keeps winning, and that's when his mindset shifts. He tells me, But Dominique, this is much simpler than I thought. And then I look at him and say, be careful, you haven't entered the psychological cycle yet. On the next trade, he loses 40%, and suddenly he discovers that famous cycle. Fear, doubt, panic, and later on, but much later, clarity. A few months later, he tells me, I thought trading was a battle against the market, but actually no, it's a battle against yourself. And that's exactly it. The third cycle, on the other hand, is individual. It's your own emotional weather. Very few people know about this third cycle, even though it's crucial. It's an individual personal cycle. Because even if two people invest in the same asset, they don't experience the same emotions at all. One might experience a small drop as a disaster, while the other sees it as an opportunity. And you know what? The difference actually doesn't come from the market. It comes from the mindset, mental. So here's how you can actually look at this emotional cycle in 5 phases. Interest, you discover, you gather information, you imagine yourself in it. Enthusiasm, you think, yes, maybe this is for me. Hope, you win dopamine rush. Then comes doubt. Am I really cut out for this when things start to go down? Stress, volatility sets in, you start to doubt. And then experience, that's when you reach a new level. You realize that the markets aren't testing you. It's you who are testing yourself. So why are cycles the key to investing without stress? This might be the truth that changes absolutely everything in an investor's mind. Markets aren't unpredictable. What's unpredictable is human reaction. Cycles themselves are incredibly consistent. When you understand them, you gain 3 essential things. You stop panicking when the market drops because you know it's just part of the cycle. You stop chasing after rallies because you recognize the collective euphoria. You better understand delegated management because you realize that professionals don't get swept up in these emotional cycles. So how exactly do these professionals use cycles? The professional doesn't try to predict the future. He simply observes the position of the economic cycle, the market mood, and the emotional state of investors. He has a long-term approach. But above all, he never confuses today's weather with the overall climate or the season we're in. A market can drop today simply because investors are having a moment of stress. But the pros, they don't panic. They adapt to the cycle. That's why many of them say, you don't win because of the market, you win because of how you navigate the cycles. What you need to remember from this key point is simple. Everything is cyclical, nothing is permanent. Cycles aren't there to trap you, they're there to guide you. And above all, you need to recognize these cycles, which will give you a peace of mind that very few investors have. It allows you not to panic when others panic, not to get carried away when others do, to stay focused on your strategy, and to use delegated management as a lever of intelligence, not as an admission of weakness. Now that you have a good grasp of the cycles, we're going to move on to something very powerful, what professional traders do differently that puts them ahead of 90% of people. Let's move on to key number 4. We're now coming to a key point that I love to share because it often triggers a breakthrough. After all, we've covered some aspects of psychology, discipline, and cycles, but there's one question that always comes up. Specifically, what is it that professionals do so differently? How is it that with the same markets, the same assets, the same opportunities, some people manage to succeed while others don't? And here I'm going to surprise you. What sets a professional apart from an amateur isn't technique. It's not their level of education. It's not the platform, and it's not even experience. What distinguishes a professional is their way of thinking, their mental attitude, their view of risk, their relationship with uncertainty, their internal structure. I'm going to give you 5 major differences. And if you integrate even 20% of them, your way of investing can be completely transformed. The professional thinks in probabilities, not certainties. This is the fundamental difference. An amateur often tries to be right. They want the market to validate their intuition. They want to predict. They look for the right moment. The professional, on the other hand, operates from a completely different mindset. They think in terms of probability, statistics, and mathematical edge. They never ask themselves whether it's going to go up or down. They ask, what are the probabilities that this scenario will be favorable? And if I'm wrong, how much will it cost me? It's a completely different approach. The pro isn't looking for the truth, they're looking for consistency. A professional trader once told me, my job isn't to be right, my job is to make money. What that really means is, teach your ego to be quiet because the market is always right. Not you, not me, the market. Where the amateur wants to be right, the professional aims to be profitable. Second point, the professional manages risk first and profit second. I guarantee you that this sentence can literally change your financial life. Amateurs start by looking at how much they can make, while pros start by looking at how much they could lose. And that changes everything. The amateur sees a potential gain of plus 20, while the pro sees a risk of minus 5. The amateur says, what if it takes off? While the professional asks, what should I do if things go wrong? Your performance doesn't come from your ability to make a lot of money. It comes from your ability to avoid big losses. When a professional trader places an order, he knows to the second where he'll exit if he's wrong, how much he'll lose at most, and how he'll rebalance afterwards. Nothing is left to chance. I have a friend who's an institutional trader who once told me, if I haven't defined my risk, I'm not allowed to enter a position. Imagine if every retail investor applied that rule. The market would probably become a very different place. Third point, the professional has a process. He doesn't improvise. This is the biggest illusion that social media creates around trading. The idea that traders are geniuses who can sense the market. Nothing could be further from the truth. The professional doesn't sense the market. He follows a process. Over and over, day after day, year after year. The process is a set of rigid rules. When to enter, when to exit, what risk to take, how to manage the position, how to assess the context, what size to use, what to do in case of a loss, what to do in case of a gain. A process is like a checklist. That's exactly what airline pilots do. Take an airline pilot with 10,000 flight hours under his belt. He knows his cockpit by heart and could almost take off with his eyes closed. Yet before every takeoff, he checks every item on his checklist. Why? Because the checklist protects against mistakes. Professional traders operate in exactly the same way. Their brain doesn't make decisions in the moment. It's the process that decides for them. Fourth element, the professional has a healthy relationship with their ego. This point, I assure you, is huge. Ego is the worst enemy of the retail trader. The ego wants to make up for losses, to be right, to hold on, to not accept loss, to prove something to itself. That is the fastest path to disaster. The professional, on the other hand, has learned to set their ego aside. I remember a conversation with a trader who managed several hundred million. I asked him, but how do you manage your ego? He burst out laughing and replied, my ego, I put it in a box and only open it when I get home, but never during the day. It's so true. A professional can recognize in 20 seconds that they've made a mistake. Not because they're weak, but on the contrary, because they're strong. Accepting that you're wrong is a superpower. An amateur, on the other hand, will sometimes hold on to a losing position for weeks just to avoid admitting their mistake, whereas a pro will cut it in 30 seconds. Another difference is that a professional will delegate anything that isn't part of their role. And that's something very few amateurs even consider. Even professional traders delegate. They have analysts, data scientists, teams, algorithms, AI tools, alert systems, and automated backtests. Why? Because a professional knows they can't do everything alone. A solo trader, isolated at home, coffee in hand, with 3 tabs open, doesn't stand a chance against the institutions. But an individual who delegates to a professional team, a team that has its own tools, processes, and discipline, has a much better chance of performing well. Delegating isn't a sign of weakness, it's proof of financial intelligence. This is what I call the CEO mindset of your finances. A CEO doesn't manage every detail. They manage a vision, objectives, resources, and a strategy. They delegate execution to specialists. In a delegated management setup like the one offered by XTERA, you are adopting exactly this approach. You're not trying to become a trader, you become the pilot of the strategic framework. A little anecdote. How can a pro win even while losing? I want to share this image, which is very, very powerful. One day I was with an institutional trader and he was closing out a losing position. Nothing dramatic, minus 1.5%. He presses his button, smiles and says to me, "Good loss." And I say to him, "What do you mean good loss? You just lost money." And he replies, "It's a good loss because it follows my plan." And that sentence is a real gem. A good loss isn't a small loss, it's a controlled loss, anticipated and built into the strategy. Retail traders, on the other hand, experience every loss as a tragedy. Professionals see a loss as just a normal line item in their business. That's why they win in the long run. In summary, what sets a professional apart from an amateur is that the amateur wants to be right, while the professional wants to be profitable. The amateur focuses on gains, whereas the professional focuses on risk. The amateur improvises, while the professional follows a process. The amateur wrestles with their ego, whereas the professional left theirs at the door. The amateur wants to do everything alone, while the professional delegates intelligently. Conclusion of this key number 4. You can now see that the difference between a pro and an amateur isn't technical skill. It's more about mindset, relationship with time, risk management, and humility. And that's excellent news because it means you don't need to be a trader, spend nights looking at charts, or become a technical expert. To adopt the right professional mindset, you can begin taking action today. Delegating management responsibilities soon becomes obvious. You finally understand what it truly means to manage your money like a CEO. And you create a framework in which your capital can grow without your emotions sabotaging your efforts. Now that you see how professionals think, let's move on to the final key. How can you build your own decision-making method? Let's move on to key number 5. Build your own decision-making method with a system that could transform any investor. We're now at a very special key because it marks a transition. The transition from theory to practice, from knowledge to application, and above all from I endure the markets to I control my strategy. In this 5th key, I'm going to share with you the decision-making method used by all serious investors, whether they're knowledgeable amateurs or seasoned professionals. A method that is simple, clear, universal, and above all, immediately applicable. And what I love about this key is that you don't need to become an expert to use it. It's a bit like a GPS. You don't need to understand the engine to know where you're going. You just need to know the destination and choose the right route. And that's exactly what we're going to do. Why do you need a method? Well, because without a method, everything becomes emotional. And as soon as emotion takes the wheel, we go back to the 7 psychological biases from key number 1. A method is what allows you to stay clear-headed when the market goes wild, to make the right decisions even when you're tired, not to panic during downturns, not to get carried away during upswings, and above all, to remain consistent. An investor without a method is like a boat without a rudder. It moves forward, but it goes wherever the wind takes it. With a method, you activate active steering. And I often say this, financial freedom doesn't come from what you know. It comes from how you make decisions. A simple but formidable method in 5 questions. I want to guide you through the exact 5 questions that professional investors ask themselves when building a strategy. These 5 questions can be asked in various contexts. Long-term investing, a delegated solution, a real estate or financial project, an overall portfolio, it doesn't matter. You'll see it works in every case. So let's get started. Question number 1, what is my real financial goal? I deliberately say my goal because many investors live with goals that aren't their own. They're the goals of social media, of other people, of promises they've heard. A financial goal should be personal, it's intimate, it's tied to your story, your projects, your situation, your personality. The worst mistake is to confuse the famous 3 financial levels we discussed in a previous course: security, independence, or financial freedom. These 3 levels have nothing to do with each other. They don't even use the same tools. So decide on your goal. Security means covering your living expenses, avoiding stress, stabilizing your situation. You don't take reckless risks in this context. Independence is when your passive income covers your needs. Here, you diversify, you think in terms of strategy, you put methods in place, and financial freedom is the highest level. Your capital allows you to choose your lifestyle. Here, you aim for optimized performance, but always with discipline. And a professional never mixes these different levels because a tool suited for financial freedom is not the one to use when someone is just seeking security, and of course, vice versa. As soon as you choose your real objective, 50% of the clarity is already achieved. Question number 2. What level of risk am I willing to accept? And here again, it's personal. There is no universal answer. There is only the right answer for you. Risk is not a technical number. Risk is how much I can lose without losing sleep over it. Do you want to know your true risk level actually? Well, it's simple. When you open your app and see a temporary loss, can you still go about your day as usual? Perhaps even without letting it affect you? If the answer is yes, you're aligned with your risk level. If the answer is no, you're overexposed. The danger is taking on a risk that doesn't suit you and then making bad decisions because your stress increases. At that point, it's no longer about finance, it's about managing your emotions. Knowing your risk level is like building a mental safety net and living better. Question number 3. How much of my capital is dedicated to performance? And this is where we talk about the trading compartment. Trading is not a complete portfolio. It's not all or nothing. It's a compartment, a tool within a strategy. For a modern investor, this compartment often represents between 5 and 15% of the total capital. Why this range? Because it's only this compartment that will help us seek performance. The rest needs to be structured, diversified, and balanced. The trading pocket is a bit like the accelerator. It's not the foundation, it's like a car. You have the chassis for safety, the engine for standard returns, and then a turbo for trading. And if you try to drive only on the turbo, you'll blow the engine. The professional's role here is clear: to use the turbo at the right time, on the right road, with the right pressure. An individual on their own can't do that. A professional can. Fourth question, do I want to act or to steer? This question changes absolutely everything. A lot of people think they want to take action. They say, I want to learn, I want to trade, I want to understand the signals. But in reality, it's exhausting, stressful, time-consuming, and it's not their job. Steering, on the other hand, is something else. It's much more accessible, it's more powerful, and above all, it's smarter. Taking action means doing every operation yourself. Steering means setting the framework, the objectives, the level of risk, and delegating execution to experts. That's the big difference between being a player on the field and being the coach who leads the team. And let's be honest, modern delegated management is about steering. It's about general management. It's about making the important decisions and letting the professionals handle the mechanics. When I look at institutional traders, what strikes me is that even they delegate. They delegate analyses, tools, signals, backtests. So it makes perfect sense for an individual investor to do the same. Question 5. Which expert or solution meets my criteria? This is where the method becomes concrete, because delegating doesn't mean trusting blindly. To delegate is to select, to manage, to monitor. And a good investor chooses their partners based on clear, very precise criteria: complete transparency, clear reporting, access to diversified capital, a consistent track record, controlled risk management, a clearly identified professional team, modern tools, a long-term vision, zero fund lock-in, and above all, alignment of interests between the one delegating and the one acting. This last point is crucial. You need to work with people who win when you truly win, not with people who win even when you lose. This is exactly what sets apart a modern model like XTERA's from traditional banking structures. You're not here to buy a product. You're here to steer a strategy in which a professional team will handle the execution. Now, one last anecdote. The decision-making framework that allowed me to change my mindset. I'm going to share something personal with you. A few years ago, I was faced with an important financial decision and I was stuck. Too many options, too many emotions, too many scenarios, the classic case of analysis paralysis. And a mentor said to me, Dominique, you'll never make good decisions until you have a decision-making system. I said, but a system? What kind of system? And he replied, always ask yourself the same questions. Always. These 5 questions, no more. then you follow through with them. That's exactly the system I just shared with you. And it has guided me in all my decisions to invest, to divest, to delegate, to speed up, to slow down. This system will simplify your life. It protects your mind and clarifies your choices. It's also this system that makes delegated management coherent and effective because you know exactly what you're doing and why you're doing it. In conclusion to this fifth and final key, here's what you might take away. A good financial decision is never an emotional one. It's a structured decision. Your performance doesn't come from luck or chance. It comes from a system. Delegated management is not giving up. It's an upgrade in your approach. You don't need to be a trader. You need to be the pilot of your strategy. Your capital works better when your decisions are clear. And with this 5-question method, you now have a tool you can use in many areas of your life, for your investments, for all kinds of situations, even when the pressure is on. This is exactly what will make the difference between those who are at the mercy of the markets and those who take control of their future. And now, well, you have all the keys. We can now wrap up this session by bringing the ideas together and giving meaning to the whole. If you're still here, it means you're one of those people who have decided to take back control of their financial life, not in some distant dream, but concretely right now. And just that alone is a huge advantage. Today, we've explored what really makes the difference between an investor who moves forward and one who burns out. And as you've seen, it's not about a magic indicator or perfect timing. It's not a stroke of genius. The real difference lies in your mindset, your attitude, your discipline, your ability to steer your decisions, even when the markets are turbulent. We've seen together that sometimes our own brain can be our worst enemy. And then we've seen how professionals build a solid discipline, how cycles work, including our own personal emotional cycles. And finally, you've been able to build your own simple and powerful decision-making method in 5 questions. Now that you have these keys, mental clarity, strategic discipline, an understanding of cycles, and the decision-making framework of a mature investor, you're ready to move on to the next level: professional, controlled, diversified, and accessible management. And this is precisely where the XTERA approach truly makes sense, because among all the existing solutions, there are very few that allow you to combine sharp sector diversification, crypto, equity, Web 3.0, artificial intelligence. An active management approach designed to capture strong trends, a unique model of transparent, trackable daily profit that accumulates, and above all, an essential concept for any investor: freedom. Because at XTERA, your capital remains accessible at any time. No lock-in, no commitment period, no restrictions. It's your money and it stays available. And that is extremely rare in the world of active management. This model, with intelligent diversification, daily profits, a compounding effect, and free withdrawals, is exactly what we've just described today in the 5 key points: a clear strategy, professional execution, emotional neutrality, methodological consistency, and simple management for you. And to be honest, when we talk about financial freedom, having a solution that offers both performance, transparency, and total freedom is an extremely important advantage. That's why I really encourage you, if you haven't already, to look deeper into this approach, to ask your questions, to explore what's possible. Today, you have all the keys to understand the why, and now XTERA will show you the how. And precisely, to present to you the vision, the philosophy, and the ambition behind this model, I have the pleasure of handing over to someone who has embodied this project from the very beginning, someone who drives this mission with passion and conviction and who supports you in this dynamic day after day. I now leave you in the hands of Stefan Paul, President of XTERA, to conclude this session. Stefan, the floor is yours.
Dominique, what can I say? Thank you so much. That was an absolutely brilliant follow-up to your previous education sessions. And I love the fact that rather than talking about the technical aspects of investing, you've chosen to enlighten us with what I see as the most challenging aspects of investing: the psychology, the mindset, the discipline, and the decision-making framework that sits behind every winning strategy. In every walk of life, keeping our mindset, our emotions, and our cognitive biases under control is always a challenge, but never more so than when we're investing. When you throw in your own money into the mix, most people struggle to handle the emotional pressure that comes from the fear of loss. Most bad decisions in life are made out of fear, especially when we're talking about money, and even more so when that fear is all mixed up with a lack of knowledge and understanding. This is why we run these education calls at XTERA. We want you to have a good level of knowledge and understanding so that you don't make bad decisions with your money. We also want to give you an insight into the knowledge, skills and expertise of our traders here at XTERA, because I suspect you're probably like me. I love the knowledge, skills and expertise that we're sharing with you, but there's no way I have the time available to do this for myself. I mean, our people are trading full time, and not only do they understand the psychology, the mindset, the discipline and the decision making framework that sits behind every winning strategy, they're putting it all into practice every moment of their working day. And what's more, their success continues to deliver amazing results for you week in, week out. This is why we're seeing thousands and thousands of people joining our platform and our community every month, as more and more people realise that delegating your investments for XTERA to manage on your behalf makes total sense. And we're totally committed to continuing these education sessions and providing you with an ever greater level of knowledge and understanding of everything we do here at XTERA. This level of transparency, along with consistently solid returns, is an incredibly powerful combination. And that reminds me, you really don't want to miss the next XTERA education session. So mark your calendars right here, right now. I'm delighted to announce that our next session will take place on Sunday the 28th of December at 4 p.m. UK time. Join us then when we'll be sharing more insights, more information and more expertise that's going to blow your mind even further. Now, while I think about it, do remember to give Dominique some feedback on today's excellent session. I know he's looking forward to hearing you. So if you haven't already done so, pop your comments or any questions you have in the chat. Like Carlsberg is probably the best lager in the world, XTERA, where your growth matters, is probably the best platform of its kind in the world. But our way of doing things means we have no competition. We never stop improving. We never stop innovating. And we never stop working to provide you, our partners, with more transparency, more understanding, and the most amazing community to support you. That's the XTERA DNA. That's what we're all about. And that's it for today's call. It only falls to me to thank Daniel for his inspiring introduction to today's session, and to thank Dominique once again for his fabulous eye-opening session, showing what makes the real difference between investors who succeed and those who don't. Finally, thanks once again to you for your time, your attention and your commitment to learning. On behalf of Daniel, Dominique, myself and the entire team at XTERA, I wish you continued success and a phenomenal day. We're already looking forward to seeing you on the 28th of December. Bye bye for now.
Young jam, all black, MZ, still screaming out that